We all want to know what's coming next, right? Will my team win the championship? Is a recession around the corner? Well, what if you could do more than just guess? What if you could actually trade on the future itself?
Welcome to The Explainer. Today, we're diving into the fascinating world of prediction markets. We're going to start with why it's so tough to predict things in the first place, then get into how these markets work, see how they compare to polls, explore how they could actually help us make better decisions, and finally, talk about some really important limits you need to know about. Okay, so let's get right into it. The prediction problem. We are constantly trying to figure out what's going to happen next, whether it's in politics or the economy. But let's be honest, our track record isn't always that great. And that is the million-dollar question, isn't it? Because getting the future wrong isn't just embarrassing, it has real, tangible consequences. You know, our usual methods are kind of full of holes. We have expert pundits who often just go with their gut. We have voters who are swayed by all sorts of cognitive biases, like fixating on the last dramatic thing they saw in the news. And yeah, you even have special interests pushing their own agendas. All of this stuff just muddies the water.
And look, this isn't just some abstract idea. When our forecasts are off, we make bad decisions. We end up with policies that don't work. We waste a ton of resources, and we miss out on huge opportunities. It really matters. But what if there was a better way? What if we could turn the whole idea of forecasting into something that looks a lot more like a financial market?
So you have these platforms popping up, like Kalshi, which is actually the first federally regulated exchange of its kind. And they've created this whole new thing called an event contract, which lets everyday people trade directly on the outcome of future events. So here's the gist of how it works. It all starts with a simple yes or no question. Something like, will inflation be above 3% by the end of the year? Then people start trading. You can buy yes contracts or no contracts. And here's the cool part. The price of a contract, which goes from 1 cent to 99 cents, basically tells you the probability the market is assigning to that outcome. So if a yes contract is trading at 65 cents, it means the market, as a whole, thinks there's a 65% chance it's going to happen. All right, so that all sounds pretty slick in theory, right? But how do these markets actually perform when you put them up against the old school method of just, asking people what they think in a poll? Well, a really big study from Cambridge University Press decided to find out. They put these two methods into a head-to-head competition, like a forecasting cage match, across 113 different geopolitical events. So they use something called a Breyer score to keep track. All you got to know is that a lower score is better, kind of like golf. A 0 is a perfect prediction. And the results? They were pretty surprising. When you take a bunch of polls and combine them intelligently, giving more weight to recent polls or to people who've been right in the past, they actually did a little bit better than the markets did on their own.
But here's where it gets really interesting. The biggest takeaway wasn't that one method beat the other. It was that when you create a hybrid, when you combine the market prices with the information from those aggregated polls, you get a forecast that's way more powerful than either one by itself. It turns out polls have some unique info that the market just doesn't capture on its own.
Okay, so if these things are so good at predicting, could we take it to the next level? This leads us to a pretty radical idea. What if we used markets not just to predict things, but to actively help us make better decisions?
This quote from Scott Alexander really nails the big idea here. It's about creating an entire industry where the whole point is to generate true information on stuff that really matters. Think about it in journalism, for example. An investigative reporter uncovers some major corporate fraud. Before they publish their story, they short the company's stock. They bet that it will go down. Then they publish their true, verifiable findings. The stock price tanks, and they profit. This model actually creates a powerful financial incentive to tell the truth.
And you can take that same logic and apply it straight to public policy. Imagine if we could run a market to forecast the real-world impact of two different climate policies before we spend billions of dollars on them. Or we could help government agencies pick which new technologies are most likely to succeed. You could even have decision markets where a government says, hey, we will pass this law, but only if the market predicts it will have a positive outcome.
So, we've seen all this incredible potential. But, and this is a really big but, it is absolutely crucial that we understand the limitations and even the dangers here. So what's the catch? Well, there are a couple of really big ones. You've got hidden costs baked into how markets work and a really fundamental confusion between two very different ideas.
First, let's talk about speed. In modern markets, you have these high-frequency traders with supercomputers that can make trades in millionths of a second. It's like they're in a Formula One race car, and the rest of us are on a bicycle. That speed advantage lets them profit at the expense of slower, regular folks. So the market's so-called wisdom isn't always shared equally.
And that brings us to an even deeper, more philosophical problem. This quote right here, it's about artificial intelligence, but it hits the nail on the head for prediction markets too. This is so important to understand. A market can be perfectly accurate in reflecting the information and, yes, the biases of the people trading in it, but that doesn't mean it reflects the objective truth. Just think about an AI hiring tool that's trained on a company's biased hiring history. It might accurately predict who the company would hire, but that's not the truth of who the best candidate actually is.
All right, so let's tie this all together. We've seen how prediction markets can take a whole mess of opinions and turn them into one single real-time forecast. We learned that combining them with good old-fashioned polls can make them even more powerful. We've explored these wild ideas for how markets could actually incentivize finding the truth. And maybe most importantly, we have to remember the difference between a market being accurate and it actually being truthful.
And that leaves us with the big final question. A question this technology really forces us all to think about. If a market gets good enough at predicting the future, should we let it decide the future for us? That's something worth chewing on.